We all know that real estate has created more millionaires than any other industry on the planet. We also know that it has created a lot of heartache due to mismanagement, overborrowing, and just simple life events that happen to all of us. Welcome to the CashFlowPro podcast. My name is Casey Brown, and I am your fearless leader. And although we might be bourbon sipping and at times foul-mouthed Southerners, we will always do our best to be honest, straightforward, and due diligent with all of the information we pass along to you. Welcome to the show. Hey there, and welcome to today's episode of CashFlowPro, your daily real estate investing podcast and YouTube channel. I'm here today with Hans Struzyna of the Gunderman Group. Hans, how are you today?
Man, I'm doing good. Thanks for having me on.
Absolutely, man. We're always glad to be able to chop it up and talk capital raising and talk syndicating and talk anything that you can basically bring to the table for the listeners. So why don't you start out, Hans, by telling us a little bit about yourself and how you became associated even with wanting to do real estate?
Yeah. So my backstory is I grew up in the Seattle, Washington area over in Kirkland on the east side of Lake Washington. And just was always kind of in the real estate world in the periphery, in the sense that my dad, my uncles, my grandfather, everyone had a hand in that business, mostly on the commercial side, brokerage side, property management, development, that sort of thing. So I always knew that this was something I wanted to do. My dad was an attorney, or still is an attorney. He was always giving me the advice that I should go work for myself and be in real estate because his best clients all own real estate. And so I always had that influence in my mind, but I took a bit of a different path to get here. I was an athlete for years. I guess I still am, but I'm not as active as I once was. And long story short, tried a lot of different sports, grew late, so football, basketball, contact stuff was not kind to me in junior high. And so I eventually found rowing, which if you're from the Pacific Northwest, it's kind of ingrained in the culture up there, and ended up finding some real success early on in that sport and ended up taking that into a 12-year amateur career all the way to the Olympic Games in Rio.
Oh, wow.
Where I competed with Team USA as part of the men's 8. We got 4th, so just out of the medals, unfortunately. But that was really like the first part of my journey was all real estate, or not really real estate, but learning how to be on a team, obviously training all the time, traveling around with the team, living out of a suitcase for most of the year, and then working in sales to try and just keep myself supported while I was doing that.
Sure. Yeah. And it's interesting. You said right before the episode that you had just hung up with your team and you all had just had a team meeting. I'd like to dissect that just a little bit. Can you give us an idea of what this team consists of that you're working with right now? Because I know, and then before we get into like specific deals or anything like that.
Right. Yeah. So you asked how. So after the after the Olympics, I got an opportunity to join a real estate sales team. They were doing a lot of wholesaling, flipping, as well as just traditional sales. They were in the Southern California market. I'm in the Bay Area now. And so I was basically using their backend to learn how to cold call and learn how to kind of do some of that because it was just that was an easy way to start the business. I then found the team that I'm on now, which is a real estate sales team. We're the number one team in the East Bay called the Gunderman Group, and have been very successful for over a decade, well before I showed up. And then I like to think I've helped contribute to that. But now we're in a point where myself and some of the other members of that team are also getting deeper into real estate, investing in joint ventures and so forth. And so I found my way into real estate through sales, through cold calling, actually in short sales was my first year I did like 9 short sale deals.
Man, I tell you what, dude, that's like saying, hey, I can't wait to get up every day and beat my head against the wall. It's going to be so much fun.
I mean, I was cold calling at least 2 hours a day minimum, trying to get to 10 contacts, because if I got to 10, one would usually convert. And if I got I think my numbers were, as long as I was getting 10 really solid appointments, I was closing like half of them ish into some form of action and put them into my serious sales pipeline. So my first year I did pretty well by California standards from a unit perspective. But yeah, it was like banging my head against the wall, because you're dealing with people who have denial. They don't think they have a problem. They think the bank is wrong. They think all kinds of stuff.
You know, it's interesting to me. I've been in business or on this planet for almost 41 years here in a couple of weeks. And I think, and I'm only saying I think, I can remember one time where a bank made an error. And you're right. Those folks, when you're dealing in that sales business, and it's a lash out of losing what they have, losing what they had, losing what they thought they had, and it's a lash out against it's everybody else's fault except for right square where the blame needs to be put. And so it's an interesting world, and even more so on the short sale side of thing, Hans. What I like, reason I said get up and bang your head against the wall every day is because the banks. I mean, by the time you have to prove your value, by the time you get this value proved to the guy that you were proving it to, while he moved on to a different job or he got reclassified amongst the company, now you got to start over, because the next guy's like, I think that's wrong. Now prove me. You know what I'm saying?
Right.
That's what my experiences were. It was so much so that I just said, forget it. I don't even. Somebody comes to me and says, yeah, we got a short sale. I'm like, listen, I'm not your guy.
Yeah. I've got a friend and a mentor at this point, but definitely a friend who, she was one of the number one REO brokers in the Bay Area. I mean, she was doing hundreds of units during the peak of it, and had all these, hedge funds and all the asset managers, all those relationships. She had like 30 people feeding her stuff at one point, but she's like, I'm letting these things go because I just can't do it anymore, because of what you just described.
Yeah.
So I then realized that was a really hard way to make a living, and not what I wanted to do forever in this business. So I found a connection through. It was introduced to me socially to the team that I'm now on and helping to run to some capacity. Is the Gunderman Group. So we're like I said, the top luxury sales team in the East Bay. We do much more volume than anybody else, and we're really blessed to be in that position and love what we do and the clients that we work with. And so,
sure.
Obviously, we work like crazy, but we make good money doing it. And so, on the flip side, during all that past, we kind of skimmed through like 8 years of time there overall. But basically, once I got out of college, all the way until I joined that team, I was very serious about real estate investing in particular. Buy and hold small multifamily was where I wanted to start. And so once I started getting to the point where I had enough of a 1099 history, and we had enough money for a down payment, we had enough confidence to do all of this, we started to get, me and my wife, and we bought our first property in 2018 out of state. So we're in the Bay Area, bought it up in the Tacoma, Washington area, which is about an hour south of Seattle. And
so a geographical area that you know, because didn't you say you're from up there, right? So you somewhat know.
Now we know it reasonably well because we own 2 properties there, and we've been up there a lot. But at the time, so as everyone knows, the Bay Area is really expensive. Cap rates are really compressed. Cash flow is hard to come by. That's what we wanted, was cash flow. And so we started going out to Sacramento, Central Valley, and I was like, I don't really want to own here necessarily. And so we just kept looking and looking. We got as far as Kansas City before we realized that we would eat up about a half a year of cash flow just flying there and getting an Airbnb.
Yeah.
So
Wow.
we then figured, well, hey, we're 1099, we're real estate professionals. We can start to write off some of these trips. So why don't we figure out a way to write off trips we would otherwise take anyways and just go do real estate stuff on the front and back end. And so that's what we started doing. We started looking in markets that were not far from where our families lived, because we're the only ones in our families in California. And then I was like, oh my gosh, Tacoma, hello. This is exactly the kind of market we want. Secondary market, it's affordable. It looks like it's got good rents. People can go to big cities, but it doesn't cost the same as big cities, in this case, Seattle. We found this great little duplex, bought it, put a bunch of money into, did a BRRRR strategy on it. And then it's literally, at least doubled in value since we bought it. And we pulled the money out, and then we went and bought another property about a mile away from it the year after. And so we really, once we did those first two deals, realized, oh my goodness, there are so many ways to leverage your money, to make money, to build wealth, not just to have a big income through selling real estate, but to truly build wealth through this vehicle that is real estate. And we're in.
Yeah, and the cash flow provides that freedom. The cash flow provides, and I'll tell you what, man. There's a lot of people that have never been through or never had the luxury of first of the month comes around, rents get deposited.
Oh, yeah.
You live that month, you do what you want to do. Next first of the month, rents get deposited, and until you've actually seen that, and you're like, and I'm always just, wait a minute, we didn't trade our time for that. You mean that was money that just showed up?
Yeah.
And again, it's the equity difference in you're living off that delta between your expenses, your mortgage payment, and whatever the rent is. And that's why having more units and being scalable. And then that's where multifamily kind of steps in. So how many units do you all own right now?
Currently we have 9, and we're under contract. We have an LOI and a PSA signed for another 33. So we're really stepping up to that next level this year.
Sure. Did you, and you said you're JV, you're doing some JV deals. Now, why don't you talk a little bit about that and what is that looking like?
Yeah. So it's been our goal to start in the small multi, because that's so almost exactly like single family. It's just a way, we knew it, right? It was, and because we were doing this all out of state. So we own in Tacoma, Washington, we own in the Cleveland, Ohio area as well, another 5 units. And so once we got to the point where we got really comfortable managing from a distance and understanding, the loan products, the underwriting, the evaluation, how to run it, water heaters, just all the roofs, all these basic things that are just, you have 2 of them instead of 1 of them in a duplex, right? It's the same thing. It's that's what we do professionally every day, actively. So that's what we invested in. And so then we got really comfortable with how this all works and not necessarily needing to have it in our backyard. So then we're like, okay, we feel very ready to go into that 10, 14, 20, 30 unit world. And so we've started to look, I've made some connections to some masterminds and so forth. And I connected with a guy in Indy, who he's a syndicator, and he puts together JVs and kind of does boots on the ground for earned in equity. And so I started connecting with him, and we started looking at some deals. And I basically was like, the deals that we want are just a hair out of reach. We need a little bit more cash than we have liquid right now. We didn't want to 1031 anything that we have, because it's all performing pretty well. Sure. And so this goes to the capital raising thing. Well, what we started to do was, it was actually incredibly simple. We just started to talk to some of the people that we already know, who know, like, and trust us about what we were doing, and just saying, just asking them, hey, do you know anybody who's got a couple of hundred that might want to, invest in some real estate? And they're like, well, we do. We would totally invest with you guys.
Sure.
We need to get out of the stock market. The stock market's been getting crushed. We'd like some cash flow. Like, if you find something, let's look at it. And it was really just that simple at that point, because they obviously had the relationship with them, but we were just in a position where we found these deals. We needed a little bit more money to come to the table, and there it was. It was right under our noses the entire time. And so now we're negotiating, and rates are moving, and it's the deal I'm hoping comes together, but the seller doesn't totally want to sell, so we're trying to figure that one out. But
man, it's hard to make somebody sell that doesn't want to sell. I can assure you.
It's an off-market opportunity, which is cool. There's a broker involved, so he's like he's serious, but it's just like, he's got to do a 1031.
Some of the sellers right now that we're dealing with are like, hey, yeah, I'll sell if I can get this price. Exactly. If I can't, I'll just hang on to it. And that's been the biggest struggle as of late and I've said it on the last 3 podcasts I've recorded, so my listeners are going to hear it again. Sellers want yesterday's prices, mm-hmm. Buyers want tomorrow's prices, and they're actually, if you're looking at it from in a reality standpoint, sellers want the day before yesterday's prices, and buyers want the day after tomorrow's prices. That's how far everybody is away, and until that starts to shift in and move up, move a little bit, it's going to continue to kind of run a little bit stagnant here, at least for in the interim anyway. So, so the Gunderman Group is actually real estate sales, right?
That's what we do professionally in our earned income world. Yeah.
And then you reinvest that into because that's really the path that I'm taking, because I'm real estate sales by trade for the last 15 years. Basically, that's both residential and commercial, a mix thereof at some point. And so one of the big things that I push for, or that I'm a big advocate of, is yes, if a real estate agent goes out there and you hit a $50,000, $100,000, $200,000 commission lick, you need to put that back into something that's going to flush you money every month. Yeah. And the reality is that I've hit those $100,000 licks myself. I've brought $100,000 commission checks home. And the fact of the matter is, and I always say this, and it always sounds so backwards to say it, but it's when I bring that money home, I'm just as broke the day after I had it as I was the day before I had it, because it's not generating anything. Yep. It's just sitting there. Yeah, you go out, you buy this, you buy that. Oh, the kid's been wanting this. The kids need to do that. Whatever. Yeah. And then before you know it, that 100 turns into 90. Then it's 50. Then it's 25. And then you're like,
don't forget that
damn.
Our tax man's coming around in April too on that 100 as well.
Yeah, he shows up. He rarely forgets where I live at. That's a fact.
Yeah.
So that's what I'm a big advocate of is educating real estate agents in general to know what they can and can't, what they should and shouldn't do with some of these bigger commission checks, because it's all right there for the taking. And when you can turn around and you got $100,000 commission check and you can turn that into an 8% pref return for the next 5 years or 10 years or whatever it is, I mean, they're going to shovel you basically $667 a month from now on, and that principal is going to stay there. That's a pretty good deal at 8% pref, So
taking a commission check and turning it into an ATM machine is the way that I look at it. We do not put ourselves into any syndications yet. I suspect there will be a time for doing that, and that's largely because we wanted the cost segregation and the accelerated depreciation on the buildings, because we live in California where the tax rates are stinking high because we've got big state taxes, but we are real estate professionals, and if we hit the IRS's threshold, we can turn those into active losses and shield, legally speaking, shield taxes and taxable income out of real estate.
That's right. Now, talk a little bit about what that threshold is.
You have to meet a couple of different criteria, but the ones that we're aiming at consistently are you either have to have 500 hours of tracked time in real estate investing. And the IRS has a very specific what does and doesn't count. You can't just look at real estate for 500 hours a year. That doesn't count. So we're going to loophole the hell out of that one.
That's right.
Or you got to be at 100 hours, and no one else in your deal can have more hours than you. That includes vendors and property managers and all those kinds of people. And so that's why we've held on to self-managing a couple of our properties, is so we can hit that threshold.
Now, what is that? What is that referred to in IRS terms? I can't remember.
What's that?
Is it in like RAM or something, or RMA or something? What's the?
I have a CPA, and she's my encyclopedia of knowledge on that front, so I couldn't tell you on that one.
Sure. Yeah, it's anyway. Yeah, those thresholds, and then you also touched on cost segregation and accelerated depreciation, which are two pretty. There's some really good. There's some really good guys women for that matter too, that you can follow, that have podcasts, that have shows, that have webinars, that have all this stuff on cost segregation and accelerated depreciation. And, especially if it's an asset you're going to hang on to, that's really kind of the nuance to the whole deal. I think, especially on the accelerated depreciation, because you don't want to turn around and pay capital gains on the whole, after you've accelerated it. And of course, I know there's some agricultural stuff too. Of course, we're big in the ag business out here, and agricultural buildings or barns and so on have a very accelerated depreciation bonus right now or whatever. So, well, that's great, man. So we went to the Olympics. We started selling real estate. We've continued selling real estate, and you've acquired some smaller multifamily, and now you're getting ready to step into a 33 unit apartment complex that's probably going to really drastically change how Hans does things, if I had to bet.
Yeah, I mean, this opportunity is really cool. We're being conservative, and we think we can this is the thing with this deal, and this is the kind of real estate that I love, is when somebody is managing it in a mediocre fashion. They're doing fine. It's doing okay. They bought it 20 years ago, but they're not paying a ton of attention to it. But that's the problem right now. On the flip side is the lenders, if you want that good, solid 30-year debt, they're going to look at the actuals. They're going to look at your T6 and then extrapolate that out to a T12, and they need to see something to get you to a reasonable loan to value ratio. Otherwise, you're sinking $1 million into a building. Right.
Now you mentioned loan to value there. Now, are you dealing with smaller credit unions right now? Are you dealing with medium sized banks, large banks? Where are you all borrowing the bulk of the money for what you are doing?
Well, everything up until now has just been standard mortgage brokers, 25% down, because it's been 1 to 4 units. What we're looking at a couple of different options, but we're looking at either a Fannie or a Freddie product right now, which we're trying to keep at like 65% loan to value, just so we don't have to sink tons of cash into it. We want that 30-year amortization on it. And the problem is the T6 is looking a little squishy, and that's the side that you hit on, is the higher price.
The T6 and extrapolating that out to T12 can be a little bit dangerous.
The T12 is not particularly good, but because he's got some vacancy issues in the past, he's had some turnover of tenants. Again, it's not being managed super well, the property, but that's what's on the books, and so that's what the bank is going to look at right now.
Yeah, and that's tough, man, because for instance, I've had in the real estate sales business, every time somebody with a business calls and they're like, "Hey, we want to sell the building, the business, we want to sell everything as one," right? Yep. And so you're like, "Okay, hey, one thing I want you to understand is these things are valued based on what they're bringing in." And what they're bringing in is what your books say, not this. Well, we keep all the cash out of the drive-through, and that's what we live off of.
Right.
So we need to include that kind of stuff doesn't work, and so it's oftentimes so difficult to get people to really understand that the basis is the books are what speak the value. The value is what speaks the loan. The bank approves the loan or doesn't approve the loan based off of that whole line of what we just discussed. And it's mind boggling to me sometimes how the human mind thinks that thinks differently or wants to escape a little bit of taxes in order to cost and value. So it's six of one, half dozen of the other.
Right. I mean, it's all trade-offs, right? Like, if someone's running their business that way, that works for them, but then their buyer pool is like this big, right? It's tiny.
Yeah.
Because
I've sold several liquor stores that have
Yeah.
had issues like that. And it's because they're high cash or they cash checks for people and there's cash coming in and going out there. I mean, anyway, it's any number of different things.
totally,
Hi, this is Casey Brown, host of the CashFlowPro podcast and YouTube channel. Have you been thinking about investing in real estate but just don't know where to begin? I'd like to help by inviting you to check out our website at www.3000capital.com. There you will find an array of material that will help you learn all about real estate syndication. And while you're there, be sure to check out our free video series download titled 5 Must-Know Keys to Success in Passive Real Estate Investing. I'd also like to personally thank you for making CashFlowPro part of your day. Now, back to the show.
It's all trade-offs, and it's just figuring out the right way, and that's where the opportunity is in that margin, right? If you can start to bridge that gap, as you talked about, sellers want 2 days ago pricing, and buyers want 3 days ahead pricing, and now we've got that gap. But that's where coming together in the middle, and especially right now where the world is in turbulence and interest rates are moving all over the place, there's tons of opportunity out there if you start to learn the levers that you can pull. And that's something that I'm really working on educating myself with, and why I have a partner who does syndications and does JVs and really understands the numbers, because I'm getting a freaking MBA in his spreadsheet, just how to look at some numbers and giving me understanding of what can be done.
And it's really tough, man, because like you said, those levers are there, and those levers are generally there for every deal. But if you start marginalizing and getting too close, those levers can really pop back up and hit you in the mouth too. So you've got to make sure that I heard somebody told me a long time ago, you don't make money when you sell, you make money when you buy. And there's so many people out there right now wanting to just cram pack a deal together that they're just about willing to do anything as far as cap rates are concerned. And and then bridge loans. I mean, don't get me wrong. I love the fact that there's value there, and I'm doing some of it myself on some personal assets. But man, it could very easily come back on the other side. So
that's the thing is in real estate investing, you got to know what are the things, like just like a real estate negotiation. What are your contingencies? What are the things you can do? What are the credits? What's possible with the lending? Same thing with this. Like, what are the metrics that everyone's going to look at? What's reasonable for your market? What's unreasonable? And just getting educated and meeting people, listening to podcasts like this one, figuring out what are the options, like how do I play this game, and then having the experience of listening to someone like yourself who's got the horror stories, and like, if you do this and something happens, it's going to come back to you, but if you do that and this thing happens, it's going to be jackpot day, right? Like,
yeah. And Hans, then you have to know what to do with that jackpot too.
Mm-hmm.
That's oftentimes the challenge. Everybody's looking for the jackpot, and then they hit it, and it's just like I said, that $100,000 commission check comes home, And then you're like 90, 80,
Yep.
50, kid needs braces. Now we're down to 40 and then on down the line. And so then you're broke again. So,
Yep.
all right, man. Well, listen, thanks for the discussion today. It's, we're excited we interview everybody from people that aren't even in real estate syndications, that just have outside businesses that help syndicators do things and make apartments more efficient, all the way up to the guys that have 4 or 5 billion under management. And we always like to get the different angles that everybody brings to this business. So with that being said, we ask a couple of questions to every guest that comes on the show. And the first of those questions is, what is the best book that you have recently read or are currently reading?
I am reworking through cash flow quadrants, Robert Kiyosaki. I really feel like that has helped me redefine my definition of rich versus wealth at a core level. And I would encourage you to go touch that book.
That's a very, very interesting point, rich versus wealth. And I think it all has to do with the time that's involved with the two, and what the wealth is when that money starts buying you the time that you can't get elsewhere back.
Exactly.
So awesome. What is a dream vacation that you have taken or hope to take?
Man, last year, November, we went to Hawaii. My wife is from Boston. She's never been to Hawaii because Europe's way closer to the East Coast.
Sure.
Went, and just the two of us, basically ate, drank, hung out at the pool, went to the beach, surfed, did whatever we wanted, didn't have to worry about it cost-wise, because we had a very good year and we had it set aside for this vacation. And that was really the first kind of if you do well and you invest well, you don't have to worry about money when you go on vacation. And that's a pretty good feeling.
That's right. Do well, invest well, and live well. There you go. That's it, man. Awesome. All right. So if the listeners heard something that resonated with them and they want to reach out and get in touch with you, what's the best way for them to do that?
You can hit me on Instagram. It's at Chief Snah, SNAH, which is my first name backwards. And then I've also got my website, Hans and Kristen, KRISTIN.com. That'll take you to our real estate sales page, but then you've got to contact me if you can see what we're doing over there.
Awesome, man. That's great. Well, listen, we really appreciate you taking the time to be on the show today. And as always, listeners, please head down and smash that subscribe button and leave us a review while you're there. Leave us a 5-star review, please, so that others can see that you like and enjoy what we do here on the CashFlowPro podcast. And again, Hans, thank you so much. I appreciate it. And listeners, we want to thank you again. I hope everybody has a wonderful rest of the day. CashFlowPro is hosted by Casey Brown, founder and CEO of 3000 Capital, a commercial real estate investment firm committed to providing its investors with ongoing cash flow and helping them build long-term wealth. If you enjoyed today's podcast, make sure to hit that subscribe button so you'll be notified about all our future episodes. You can find more information about us and our investment philosophy by clicking the link in the show notes below. Thanks for listening.